Hi, I'm Edward Pritchett. I've been in the life insurance industry now for over 15 years. And I wanted to share some information about how a certain life insurance product can help you plan and prepare for retirement in a way that nothing else can. Now, let's talk a little bit about some of the factors that are going to affect your retirement income. Number one, what are you saving right now? What are you investing right now? What are you putting into a qualified plan such as a 401k, IRA, Roth, any of those type of vehicles? And what are you just saving maybe in a bank account, under your mattress, maybe out in the backyard, right? We all are looking for ways to save and put money aside. And there are many different ways to do that. And I think one that is missed is using the power of life insurance as a vehicle for setting aside funds for your retirement. Now, let's talk about another aspect that is going to affect you in retirement. So first, you have to start saving something now. You have to start putting something away right now for retirement. But then you have to consider taxes. Now, here's a question. Do you think taxes are going up or going down over the next 5, 10, 15, 20 years, however many years it's going to be until you retire? We can take a look at it, right? We can look and see what has happened to taxes over the course of X period of time. And what we usually figure, and what most of the people who are really on top of this from an economic policy standpoint, and who have been in not just this industry, but the industry of politics, banking, and finance for quite a while, is that the higher our nation's debt goes, the more they're going to have to raise taxes. And I don't see that net national debt going away anytime soon. Let's take a look at that, right? If the national debt influences the tax rate, then what do you think is going to happen over the next 10, 20, 30, 40 years? So if I am going to have to pay taxes on income that I receive, when do I want to pay those taxes? Do I want to pay taxes on the seed, what I start investing and saving with, or do I want to pay taxes on the harvest? Think about that one for just a second. And the reason that I put it in that term is because if I use some of the qualified plans that are out there, which are great, those are tax deferred plans. I don't pay taxes now. I get a tax break, right, today, but when I take that money out in the future, I'm going to be able to pay the taxes that are due at that point in time. Not based off my tax rate today, but the tax rate that I'm going to be when I decide to pull that money out. And do I think that's going to be higher or lower than it is today? Now, the other way I can save money is I can put it into my savings account, or I can put it into a brokerage account and invest it myself, or, it's something that I own. It's equities or mutual funds, right? That is going to be taxed now. If it's not in one of those qualified funds that I just talked about, it's in one of those another type, which is just a non-qualified or just a standard brokerage account, a standard savings account. As I make gains on that, I'm going to pay taxes today, which isn't bad, but then I'm going to reinvest it and continue to pay taxes on it the next day, and then reinvest and so I'm always going to be taxed on any gain I make as that money grows. Now, another way that I can do it is to do it in a tax-free way. And there are a couple vehicles out there, but the one I'm going to talk about today is a life insurance policy. Now, inside of a life insurance policy, there are tax advantages where you can have compounding growth in the policy, and you're not taxed on it as long as the policy remains a life insurance policy. And this is how we're able to use, even though I might get a little bit more growth, and that's what I hear a lot from people who are detractors of this strategy, is that, oh, you can get so much more growth over here, but they haven't factored in the taxes. If I can get the growth and not pay taxes, if I can get a part of the growth and not pay taxes, I'm going to do better with a tax-free strategy than a taxed strategy. So those are two of the key issues that you have to take a look at when it comes to your retirement. How much and what can I save, and how is it going to be taxed? A third part, all right, a third issue that I obviously want to take a look at is, how is my money gonna grow? What is it invested in? Am I in something that has a lot of volatility or no volatility? Am I in something that allows me to have benefits while I'm investing my money? In my qualified plan, there's gonna be volatility. As the market goes up, my investment assets go up. When the market comes down, my investment assets go right there with it, right? Maybe you're trying to time it and you're liquidating and you're getting into cash during the bad times, but what most people have found is that most people are not very good at timing the market. It's why the advice out there that you typically hear is buy a low-cost index fund and just stay in that low-cost index fund and leave it alone, right? You're gonna have ups and downs, but overall, you're gonna be up in the long run, which I agree with that principle. What I don't wanna do is then pay taxes on it later. And I wanna be able to use that money, if possible, and if it's needed, while I'm investing. But if I pull money out, then I lose the opportunity for my growth to compound if I'm doing it in a qualified plan. Plus, there's a lot of provisions on what I can and can't touch that money for. Now, if I'm in a non-qualified plan, it's just my brokerage account, I run into the same issues, right? I can touch it when I want to, but if I pull it out, I'm not making any more money, and I'm dealing with volatility all the time when it comes to that particular type of policy or that type of account. So, what are the benefits within an account inside of a life insurance policy? Well, the number one benefit to me is it's a life insurance policy. As I'm putting money into that policy, if something happens to me too soon, I don't actually make it to retirement, my family has a death benefit, right? If I put $200 into a savings account and $200 into a life insurance policy and die the next day, what's gonna be more beneficial for my family? You guessed it, the life insurance policy, right? So that to me is the number one benefit. In addition to that, as the funds are invested, there's a portion of the premium that I pay each month that goes to the life insurance, and there's a portion that gets invested in an indexed account. That account is indexed to one of the major market indices. It might be the S&P 500, might be the Dow Jones. There are many insurance carriers that have these products, and each of them have different indices that you can select to be able to have your funds grow in. And typically what you're gonna see is that they're gonna say there's a cap on how much we will pay out based off what this index does. So that cap might be, and I'll show you here in just a little bit what it looks like, that cap might be 11%. So it doesn't matter how high that particular index goes, the most you can earn would be 11%. But the benefit is that there's a floor. The floor is 0%. So when that same index goes down negative 18%, like the S&P 500 did in 2022, right? I have my principal locked in at 0. And so now when I start the next year, I get to start from a plateau as opposed to the hole that everyone else had to start, who was also in the same index that in the same time that I was in the year before. So I get to start from that 0 point and now see in the next year, is the market gonna show a profit, and my money gets to grow from there. So it's that downside risk protection, that place where I can't lose money whenever I have my money in this particular asset class, all right? The other benefit that I have that is available to me when it's in a life insurance vehicle is I have the ability of leverage. I have the opportunity to take a look at what value that I have in there, and the insurance company will allow me to borrow against that policy, not pull money outside of out of the principal, but actually borrow against what's there, against the value that's there, and be able to use that money for what I want. They'll charge me an interest rate for that. But if that interest rate is lower than what I'm earning within that particular cash value appreciation tool, then I am still making money on the money that's there, right? Now, this is assuming that the policy is set up right. You're talking with someone who knows how to set this up for you so that you can do it in that particular way, all right? This gives you the opportunity to, in essence, use your money twice. Because my money is still sitting there growing, I'm using it to finance that vehicle, purchase a rental income property, maybe do some renovations on my home. Number one is I don't have to borrow from the credit cards, the banks, and everybody else that's gonna charge me a 9, 12, 15, 20% interest, right? I get to save on just not having to borrow from them, and I can borrow from myself. Because typically the interest rates on the loans from your policies are around 5%, all right? So this gives me the ability to access those funds during the time that I'm living, and then I can pay that back to myself, or God forbid something happens to me and I do pass away, I haven't paid off that loan, the death benefit will pay off that loan, and what remains will still go to my family. So this is how you can use a life insurance product to grow your money in a very specific way, in a way that mitigates loss, in a way that allows you to get consistent growth and gains, and keeps you from having to pay taxes on that growth. The last benefit that I'll mention, and this depends again on the carrier that you work with and the product that you get, so talk to a licensed insurance agent that knows what they're talking about, right? Look for those experts, people who have some experience and who are working with a company that this is something they specialize in doing. Many of these policies have what's called a lifetime income benefit rider. What that is at a certain point in time, you can lock in your policy, turn this rider on, and the insurance companies will give you a specific payment every single year for the rest of your life, even if you pull out more money than the cash value says is actually there. This is a way that you can set up your own personal pension. People have used annuities to do this for quite a while, and now there's the capability to do that with an actual life insurance product. So I wanted to make this just to inform not only agents who are working in this industry about a very valuable product for their clients, but also for you. The person who is wanting to make sure that they're taking advantage of all the opportunities to grow their wealth and retire in a way that is not just comfortable, but in a way that allows you to keep living even after retirement. If you haven't learned everything that you can about this and made a decision to have this be a part of your retirement strategy, give us a call. Shoot us a message. You can direct message us here, wherever you're watching this. I don't know what platform you may be watching this on, but send us a message, give us a call, and we can connect you with an agent that can help you do this. It might be myself, but we can make sure that you're in touch with someone who can help you look at how this can work for you and what that would look like. If you're an agent that wants to be able to do this for your clients, give us a call, send us a message. We can connect you with the groups and the carriers that can help you do this and do this in the right way, plus give you the knowledge and information that you'll need to do it for your clients. I hope this has been helpful. I am looking forward to you having the kind of retirement that you have dreamed of having and the kind of security as you build it like you've never had before. I'm Edward Pritchett. Thanks for watching.